All right, so this video is going to be a lot more, I guess, technical than a lot of my videos. However, I think this video is also going to be one of the most useful if you actually go and use it. So today we're going to be talking about using software, code that you write, and also AI to help you statistically analyze a market to find real high probability edges and high probability occurrences over tens of thousands of days of price action and many, many years in a mechanical way that you don't have to backtest. Like you yourself don't have to backtest at all. Personally, you could have code do that and it could do it way faster than you. And yeah, it makes everything easier. So I understand if this video does not get as many views as my other videos. A lot of people are going to click off immediately when they see that this is complicated at all. I'm sorry. To have the ability to do some of the stuff that we're about to show in this video, it is going to be a little bit complicated. And I personally am using Python as the programming language. You don't necessarily need to know Python. You don't need to know how to program really at all either. AI is pretty goated for that. But if you did know the basics, it would be helpful. So first and foremost, if you want to follow along, you're going to have to download Python, which is the programming language that I'm using here. When you click on this download, there's going to be a little box that says add to path. Make sure you click add to path. Otherwise, your whole installation is going to be messed up. You're going to be like, why isn't it working? Blah, 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 yada, yada, yada. And I'm telling you this right now, I'm not going to be tech support in the comments. So if you're asking me questions about why isn't my program language installing right, blah, 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 I'm not helping you. I'll engage in conversations about the data and about some of the things that we show here, but I'm not going to be your tech support, okay? And then for my editor that I am personally using to write code in, you could use Visual Studio Code. That's the default one that most people use. And then as for an AI that I'm using, I'm just using ChatGPT. I have a paid version of ChatGPT, but the free version of ChatGPT literally works just as good. So don't even worry about that at all. So the first thing that you're going to need is a data list of candlesticks. So what exactly we're going to be doing here is I want to collect all. For me personally, my interests lie in 1 minute candle data in market hours because that is specifically what I want to trade. You could download a data file for only daily candles if you only want to see daily candles. But as you can see, I have a data file here with 5.7 million lines that goes all the way from 2008 all the way into 2025. And this is every single 1 minute candlestick that's ever been printed since 2008 on NASDAQ. Every single one, even outside of market hours. This shows every single one, and it gives me the date, it gives me the time of the candle, it gives me the opening price, the high price, the low price, the close price, and then the volume that was traded in that particular candle as well. So when you have data like this, and I'll tell you how to get that data in a minute, when you have data like this, you basically have the chart, right? When I'm looking at a chart, all the chart is, it's just a measure of this is the time, it's an opening price, it's a high price, it's a low price, and it's a close price. So if I have all of the data of every candle from 2008, well then I could start to potentially write software that analyzes this data for me and can start to tell me very high probability things that occur over and over and over again in ways that you might not even be thinking about just yet. So this could get very exciting very quickly. But how do you get this data? And I'll tell you, it's hard to get. I actually had to pay for this data. For this candlestick data, I paid $100 for all the 1 minute candle data from 2008. You could get daily candlestick data for free everywhere on the internet. Just look up NASDAQ historical data. If you're in my Discord and you somehow stumble upon a channel where there's this data file in the channel, just know that that is not the one that I bought from the website for $100. I'm not redistributing anything because I would never do that. All of the data in that file I collected manually by hand over the last decade, if you catch my drift. So But if that's not the case, I cannot just leave this data file in the description because this data file is the one that I downloaded from that website that I bought for $100. So I can't just give you this. However, if you do want historical data, all you have to do is type in on Google historical data for NASDAQ or whatever asset class you're trading. If you're trading futures, make sure to type in futures, and then you'll get all the data, right? And then go open up your data file in Visual Studio Code and just make sure that it's similar, and make sure that you could label everything in a CSV type of format. So this wasn't here when I first got this file, but I wanted to add this. It's going to make parsing the file a little bit easier. By the way, by this point in the video, 87% of everybody has already clicked off. Because this video is just a little bit more technical than the other ones, by the way. So I labeled it. So the first column here is the date time. So in a CSV file, you see how everything's a comma, 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 comma. I labeled the first one date time, so it's the date and then the time. And then we have the opening price. That's the second one here. We have the low price. That's the low price here. We have the close. That's the close. And then we also have the volume as well. And make sure that all your data is the same. Make sure you have good data, and then we will begin the process. So first and foremost, what we got to do is actually process this. So if your data file looks similar to mine, how do we actually get this into something that's usable to have any in order to start doing any sort of analytics or statistical analysis about particular candles? So this is my main file right now. I removed a bunch of stuff so that we could redo it in this video. But the first thing that I wanted was a way to separate out only the candles during market hours. So I have this function called load candle data that we'll look into in a minute. And MOH means market open hours. So what I mean by that is I only want to filter for the times between 9:30 a.m. New York time to 16 o'clock, which is only the time that the U.S. stock market is open. That is, for me personally, right now, what I'm looking at, that's what I'm interested in. You could also just have all the candles that I've ever printed. You could also just have all the daily candles. But for me, personally, I wanted a way to filter to only have the data of market open hours, 1 minute bars, which is what these are, by the way. These are all 1 minute bars, because I personally trade on a 1 minute chart. This is going to be individual to you, right? Like if you trade on a 5 minute chart, go ahead and download 5 minute candle data, right? You could do that if you want to. So if we dig into this function, all load candle data is going to do is it's going to take this MOH, which is market open hours. If this is true, and I pass this in as true, by the way, again, I'm not explaining how to code. So if you don't know how to code at all, you can literally blindly copy paste this and you'll be okay. If you know how to code a little bit, you'll be able to follow. If you really want to get into the analysis of these candlesticks, I would highly recommend just learning a little bit of Python. It's a very easy programming language to use, and AI is very, very useful for the parts that you're not going to be able to understand. So the first thing that I do is I check if a cache file exists. So a cache file is a file that encrypts that data after we parse it and stores it in a binary format that's easy to unparse. Because reading through 5.7 million lines, even for a computer, is going to take a while. And you'll see when we generate that cache file, it's going to take some time. So if it does exist, we're just going to use Pickle, which is a standard library in Python for compression or not for caching. And we're going to just load that file, opening it on an RB, which is the binary format. And then if not, we're going to unfortunately actually parse the entire CSV file, which is going to take a while. And this MOH parameter gets passed into that. And then either way, no matter what we do, we're also going to just go ahead and dump the data back into that cache file to make sure it's always cached. And then we're going to return that candle data. And right now, candle data is basically the format that we process things into. So this parse candle data function, what it's doing for me right now is basically I create this candle data variable, which is a dictionary here, I open the data file, and by the way, I have a file here called constants where I'm keeping constants. You could use this daytime time thing here, which is going to be really helpful to you, to be honest. So that, for example, market open is 9:30, market close is 16. Right, this is exactly what we want. And this is my cache file, this is my data file. So whenever you see the variable named data file or cache file, this is what you're looking at. The data file is this motherfucker, that's huge. And the cache file is not yet created because it's not cached yet. Again, a little bit more complicated than you might have hoped. Everybody that is watching this video has clicked off by now. So for those of you still watching, you either know how to code a little bit or you're very interested in this. So appreciate this video because it's going to be a bit of a longer one because I really want you to get excited about this because I believe that statistical analysis of candlesticks like this and candlestick data can provide astronomically large probabilities in a particular edge to give determined price ranges in the market, and it could highly improve your profitability. So we open this when we're parsing the data. I stream it with the csv.dict reader, which is an iterable file, and then you could basically just stream it in this for loop. And the reason that you want to do this, because this reader is a dict reader object, and I'm pretty sure this is streamable. So that means you're just processing it line by line. Instead of reading the entire file and then processing all the data, you're processing every single line as it reads the file. And the reason that's useful is because it's 5.7 million lines. So you don't want to go download all the data from that file, put it into memory, and then process it. You just want to have to do that once. So then for every single row in that file, so that's every single row inside of this file. By the way, this is just the boring stuff. We'll get to the cool stuff in a minute. This is just the prerequisite stuff that you have to have. We go ahead and parse the date time into a datetime object by taking the row of date time. So when I say row of date time, if you open this file, it's literally just each one of these is a row in the data, and the date time is this section right here. Okay, row of date time. Hopefully that makes sense. So I'm just taking that and I'm parsing that into a date time object that's easier to work with, because then we could go dt.time, for example, and actually do stuff. So if MOH is true, that means I only want candles inside of market hours. So if I use this function and MOH is true, basically we're going to say, and also not, I could have done this easier. I don't know why I did it like this, but market open is less than or equal to date time. So that means if it's before market open or after market close. So basically as long as it's not outside of market hours, this will just pass. If it is outside of market hours, we're going to continue, which is going to skip the rest of this loop and go again. And then if this doesn't execute, that means the row that we're looking at is within normal market hours, which then we process it into this candle data variable here. So we take every single row, right? We get the date string, which is just going to be the year, the month, and then the day. And then we modify the rows directly from the reader. We're doing it like this, so it's a little bit more efficient, because again, 5.7 million lines is a lot. And make sure you convert them to floats and everything that you need to do. And then basically I just check if that date is already in the candle data. And if it's not, then we create a new day with that date string. We say what day of week it is. This is going to be the structure of our candle data. And we have a list of candles. And then if the date string is already in there, we just add the candles. We just add the row which is the candlestick, to that particular date, and then we return the candle data. So what that gives us at the end of the day is if I print candle data here, and by the way, you're gonna see how long this takes. You're gonna see how long this takes to parse the CSV file, and I'm gonna show the whole thing because I'm not editing this video because this is gonna be a long video. So let this rock for a minute. This is why caching is so important. You're gonna see the usefulness. Like this whole weird process that we had to do with caching. You might not understand it. Just watch how long this takes, and then you'll be like, yeah, caching is a good idea. So this is gonna take a minute. I'm gonna let it play real time so that you get to experience the fucking pain of not caching data. So let this rock. So you see it just created that cache, so that means our data should be good soon. And here we go. It's starting to print everything. Obviously, it's printing out 5.7 million days worth of data. We don't need to see all of this, okay? But you could kind of see, it's not pretty, but you could see how every single object has a date time, which is that date. This is basically the candlestick data. This was the 2008, the 14th day of the 11th month. This was the 1453 candle, and I have all of the 5.7 million candlesticks in here, which is great. So, like, for example, if I print the length of candle data, and by the way, now that we have that cache file, watch how long this takes to run. Done. Boom. Just like that. 4,442. So you might be like, that's not 5.7 million. Yes, but remember, our data looks something like this. So we have a date like this, and then we have a day of week, and we have candles. So this is, by the way, helpful Copilot. This is what our data actually looks like. This is what this candle data dictionary looks like, right? We're gonna have a particular day. It's gonna tell us what the day of week it was on this particular day, and then we're gonna have a list of candles. So if we go into, for example, let's just take this right here, which is this particular date, and then we go just looking at the candles of that particular day, you'll start to see that just in that particular day, 2008, 01, 02, there was 390 candles. Okay, and why is there 390 candles? Because in market open hours, right, just the hours between 9:30 a.m. and 1600, when the actual stock market is open, there's 390 1-minute candles. Okay, but there's something interesting here, because not every day is going to have 390 candles, because not every day is going to be a full day. And the reason not every day is going to be a full day is because there's some half days, right? There's some bank holidays where volume is really low and a lot of bars don't have volume. So you need to filter this a little bit more, because although you have these 4,442 days from this candle data with only market open hours being true, there's going to be some of those days, not a whole lot, probably roughly like maybe a few hundred, where it's going to be a half day of price. And I want to kind of slim the data down where I personally, I don't trade half days. I don't trade bank holidays. I don't trade anything like that. So I don't even want those particular days in my data. So now we got to do something like this, because check this. If I go, if I do something like, I hate when that shit happens. If I do something like 4-day in candle data, there we go. And I do something like this, what you're going to see is that, and by the way, just that cache is going to come in clutch. Notice how a lot of these days are 390s. So most days are full days, but you're going to get a couple 225. You're going to get a couple 210s or even like 389s and stuff like that. Because the particular data that I have for my NASDAQ data, it doesn't count candles when there's no volume, and some days are half days. So what I want to get rid of and filter out all of these like random days where there's only 210 candles within market open hours, because those are days that I don't even want statistics about, because those are kind of anomalous days. Those types of days don't really, they're just not the same as everything else. And trust me, filtering these out is going to make the data easier to utilize in general. So I have a couple helper functions in a helper file. Okay. And that's what this get full day function does. So if we bring this down, basically I have the candle data and expected candles. So the way that we use this is going to be candle data. We need to call get full days. Remember, this load candle data is going to be the actual candle data. This function will return the candle data. That's the first argument to this function. And the amount of expected candles per day is 390. So it should, this function should almost be called like get days of length, right? Get full days of length. So now that's 390. So now, if we remember, if we do this a little bit differently and just compare quickly, so FD candle data. So this is going to be stand for full day candle data. Get full days candle data 390. Now if we print the length of each one of these, print length candle data, and then we also print length of full candle data, you'll notice there's going to be a difference, right? So there was 4,442 days that we got, but there was only 4,270 full days. So again, a couple hundred days were cut off by doing this, because we're removing half days, we're removing holidays, we're removing bank holidays, we're removing any sort of days with weird, very, very, very low volume where there's like 0 volume bars during the day. Basically, we're refining our data down into something more usable. So now we have actual data that we could start 22 minutes into this video. We have data that we could start actually doing very cool analysis with. And we have 4,270 days of full intraday price action on a 1-minute chart, all candle data. This is where it starts to get very, very cool. All right. And by the way, I have one more helper in here called filter data by year. So this is basically just being able to go, if I go filter data by year, which you guys could probably just read that function. I could say I have this from year variable. So if I do 2008, this is going to go give me all candles from 2008 and onwards. If I do 2020, for example, this will give me all candle data from 2020 and onwards. So this is just a cool function to help you. And this is the function, by the way. If you want me to go through it, I guess I can, I suppose. You have candle data from year, and then it's just going to create a new dictionary of filter data, and you're going to have a date, which is this. And then you're going to say for every date and data, which is the key and the value in candle data dot items, which is iterating through this dictionary. If this sliced to 4, so the actual date turned into an integer is greater than or equal to than the from year, then we put it in. So data for date and data in candle data dot items if the integer form of the year portion of the date, not the time, which is why you have to slice it, is greater than equal than the integer form of the from year that you put in, you'll be good. And then that's going to return filter data. So just another little helper that I have so that so that we don't have to, so that we can be a little bit more selective with the data range that we're testing particular things on. So now that we have this, first off, let's tell ChatGPT what the structure of our data is, because it's important that it knows what the structure of our data is. So if we do like 2008-01, and then is it gonna do the thing that day of week candles? I want to get that the structure of our data again. Candle data. Okay, I need to just show this a day of data. So let me do print oh my gosh, candle data, candle, I can't type apparently, candle data of, let's pick a random day, we'll just pick this day. And the reason that we want to do this is because we need to tell ChatGPT the structure of our data so that it could help us. So the structure of our data is, let's pull this back. Okay, so this is what you, like, do this with ChatGPT, because we're going to use ChatGPT to automate a lot of this code writing, so it's way easier for us and we don't have to, like, think about shit, okay? And you want to be descriptive with it. Say, I have a huge dictionary of candle data, and it's shaped like as follows. So the way our candle data is shaped right now is we have a dictionary where it's, and I wish Copilot would just show me this right now, where we have our day, day, and then we have our, this is going to be, no, we have 2000, I think it looks like this. Am I fucking tripping? Here we go. And then we have day of week, and then we have candles, and then we have, yeah, this is exactly what we have. And then we have boom, 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 boom. And then this is going to be a list of candles. This needs to know everything. We have a daytime object. That's our list. And then bingo. So ChatGPT understands the shape. So boom, we got this. This is the shape of our thing. Do you understand the shape of this data? Candles is always going to be a list that is 390 long, and the overall dictionary is going to contain thousands of days. Understand. And you really want to tell ChatGPT everything about your data so that it understands it right. So when it writes code about it for you, it writes it correctly. Okay? And it says, yes, I understand your data, blah, 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 the entire dictionary. Let's do something cool now. So we're finally 30 minutes into a cool part of this video. So let's do something interesting right off the bat. Let's talk about the median move that price makes over time above or below the open if it's a particular color day. So when I say a particular color day, so for example, I'm not talking about an up or down day. I'm talking mostly about a particular session. So like if we come here, for example, and we have the market open session from 9:30 to 1600. So if this is going to be a down day like it is today, what is the average amount that price has moved over the since 2008 above the market open on a trending down day? This would be cool information to gauge, right? Because then you could say, well, if I'm expecting a very high probability down day, for example, well, how much wiggle room is there going to be above that market open price? And this is something that's very easily done if you have data. So one thing that we need to be careful about is, again, if this goes back to 2008, understand that price was way smaller in 2008, right? Price action just didn't, like, in actual points, like this whole day is like 100 points. Nowadays we have thousands of points a day. So it's important when you're talking about distances in these datas, you want to measure with percentage distances, because as price gets higher and volatility gets more, percentage will be more closer to the truth. So we can describe this to ChatGPT and it will write code for us to determine this with a pretty cool and high degree. And I'm going to show you a bunch of examples of cool things, and then I'm going to let you all rock on your own. And I also have a Discord channel in my Discord just about data, so we'll let it go. So let's ask ChatGPT, write me a function that takes in that candle data and tells me the median amount of distance in percentage that price moves above the opening price on a down day, and the median amount of distance in percent that price moves below the opening price on a up day. Just let it rock, right? And it's gonna write me a nice, great function that I could just copy and paste. You definitely want to double check it. And then it's going to think about that shit for a while. But think about how this could be useful. And this is like one of the least useful things, by the way. I'm just starting slowly, and then we're going to start doing some more cool shit. Think about why this could be useful, right? If you're expecting a down day, right, you can't use simply data without a trading strategy. I think you should have levels and stuff. But if it comes out and it says like the average percentage move is 0.17% or something, and it comes up to like right here, then we could start to think about potentially, if there's a level there as well, and I'm expecting a down day, that could be a huge probabilities booster to a short position that's being taken. So it's accommodating. It's doing well. It's showing us example usage as well. And here we go. So let's just copy and paste this. Right, we have candle data. Get rid of the test candle data because we're not using test candle data. We already have candle data, but we want to use the FD candle data on here. So let's turn this into FD candle data, and let's let it rock. So run this. It's going to calculate that particular statistic for us. And here we go. So on the median percentage move above the open on down days is 16%. And you could also do median. You could do the max, the range, whatever. So we could say, well, this was a down day. And if this is true, since 2008, over 4,000 days of price action, on average, if it's a down day, price will move 16% above the open on a particular down day. So we just take this price range and we go 14, 15, 16%. That takes us to right here. Wouldn't you know it? Interesting, huh? It's interesting how the data kind of lines up with what reality is. Okay, well, let's try a couple more days. Let's go to the previous 930, where we have it right here. So this was a up day in price. And of course, you're not going to know if it's an up day or not in the beginning. However, if it is going to be an up day, what's the average that it moves in the opposite direction of market open? Well, on up days, on average, it moves 17.1% lower. So drag this down, 14, 15, 16. Wouldn't you know it? 17% is right here. And that's exactly how far it went lower. And it's not always going to be exact. Remember, this is averages. So there is going to be extremes where, sometimes it goes way further and sometimes it goes way shorter. Let's try this next example. For example, here's the market open price right here. On average, price moves on up days. On up days, price moves 17.1% lower than the open on average. And in this case, it doesn't even reach, right? That's okay. Again, these numbers are median numbers. So this is going to be the average number. It does move relatively close to the average. So this is why like high time frame levels are important, right? Like if you have your high time frame level right here and it's like, well, it moved pretty close to that average amount. This could still be an odds enhancer if you think this is going to be a bullish day, that potentially that initial move below the open is maybe done, for example. And you could go back and backtest. And not only could you backtest this, you could write in a code. You could be like, okay, well, how many days actually, if it's a very bullish up day, how many days actually meet this criteria, for example? But this is just one thing that you could do. And you can move this to a different file and save this function if you want it. And all you do is you just put it in a different file. You could import it, and you could do that if you want. If you want to save those calculations, save that data. Now, however, let's say that we want to do something else. So let's say that we want to understand. let me try to think of something that's pretty cool. Okay, let's do the range of price. So let's see how likely it is, for example, for that first 30-minute range that is here, right? If one side of this first 30-minute range gets broken, how likely is it that the other side will also get taken? And how likely is it that that could hold? You could imagine that this could be useful because if, for example, let's say it spits out a number where if you break the first side of that 30-minute range, let's say it spits out a number where it's like 70% chance that the low will not be taken on that particular day. Well, in that case, you can be very confident in buying a pullback, and any setups you have down here are going to have a tremendous odds booster. So how can we implement that in code? Okay, now write me a function that takes a given range of price in duration denoted by minutes. That's not how you spell minutes. Here we go. So this function is going to take a duration and then keep track of the highest and lowest price in that range, starting from the first candle in the data, and then tell me the odds of if it breaks one side, it will also break the other. If it breaks one side, it won't break the other side. So hopefully this makes sense. And then you could also read through its thoughts to make sure it understands what you're trying to talk about. So it's a user wants a function that takes a range of price in minutes, tracks the highest and lowest price within that time frame, and determines the odds of breaking one side without breaking it. The range of price part is unclear. I think it's returning over a given window in minutes. It might be key in creating this function. Got it. Now I got to proceed. 1 minute intervals. It uses to track highest low starting from the first candle of the day. So it understands that, and it needs to calculate the odds of price breaking one boundary but not the other. So for each day, after collecting the high/low over that window, I need to compute the chance that one side breaks, the other side won't. So it pretty much understands the function, and if you read through its thoughts and it pretty much understands the function, that means it's probably going to get the implementation right. So let it write out its code, and we'll be even able to edit this a little bit too. And by the way, I'm being a little bit hazardous here. You should double check the code. I'm just demonstrating. I'm just demonstrating things that you could do. So let this rock for a minute. I don't know why it's doing so many fucking initial datas here. I just want to see how it's printing it. Okay, here we go. So run this up, copy the whole code, just copy everything. Get rid of all of its sample data because we don't need sample data. We're using real data here. And then we could do FD candle data. Let's do a range of 30 minutes, for example. And let me make sure it understood it. I think it all looks good. There might be a bug, there might not. So it's just gonna see this, right? Boom. 59%. So there's a 60% chance that if you break one side of the first 30 minutes, you will not pierce the other side. Why is this useful? Again, I think it's very easy to see why it's useful. Because that all of a sudden means that if you get a pullback near this low on a day that's already broken the high, there's automatically a 60% chance that this low will not be broken anymore. So that gives you odds, and that gives you real data. Okay, so but maybe it's different data for if it breaks through the high and breaks through the low. So let's relay that to ChatGPT and see if it can make adjustments. Okay, now track the you want to word this very clearly to ChatGPT because sometimes it could be stupid. Now track in specific the different probabilities for if it breaks the high and if it breaks the low first. I want to see if they are different. Okay. And this is from 2008, right? And if you want to get a more bias to recent data, you could just come up here and be like, well, I just want to see from 2020. Okay. I think stuff like this from 2008 is just fine. So user wants to track probabilities if a breakout happens at the high first versus the low. Let's see. Always read its thoughts. If it understands what you're trying to say, the code is probably right. Okay. I need a red function that calculates one above the high and above the low. I'll consider checking the initial range. Track whether the breakout happens at the high or low first. I need to create a function that tracks the breakout for days. I'll calculate where it never breaks the low afterward. I'll do the same thing for days where it breaks the low. This is perfect. And here we go. So boom, we have this. So now this is an example of how we can change a function, right? We just asked it to create something, and now we're like, hey, can you do something else that's similar to this? So now we have full day candle data. We want this on a 30-minute chart, and let's let it rock. I think right now, this is from 2008. So here we go. Look, we have a percentage difference. It's small, but it's there, right? If you break the high first, it's a little bit more likely. It's 60% chance exactly that the low will not break. Over 4.4 thousand days of data, that's the percentage chance that this low will stay intact if the first 30 minutes does not get ran. If the low breaks first, there is a exactly 58% chance that the high will not break at that point. This is interesting data, but this is also not the only interesting data we could get. We could go much deeper. We could think much harder about cool things to put. So let's do a couple more cool things that we could put into here. Okay, and then I'm gonna leave you to it. And if you want to do more, I'm personally doing more all the time. I'm really starting to heavily look into this stuff now. So realistically, like I'm not going to show you everything I'm doing, but if I'm showing you the full process so that ideally you could do this yourself. Listen, I'm not even writing this code. I don't know what the fuck this does. I could probably read through it and figure it out and be like, is there any bugs or whatever? But as long as ChatGPT understands, AI has gotten so good where it could write the thing for you, which to me, valid, bro. Totally valid. Okay, now I think it could be something cool to track potentially on days where you do have a upward sloping session. What is the average percentage that price moves higher? And then also, we could do that, or we could do the average time that the low and highs of the session are set, and what probability that is. I think that might be better because I think this medium distance thing actually is very cool, and I've already done that. And to be honest, I don't really want to put that on the internet because I think there's probabilities there to have like 99% win rate set up. So to be honest, if you want to do that, you got to go through all this whole process and figure that shit out yourself. So what we're going to do right now, though, is I want to see potentially, I want to ask ChatGPT a question. I want to say, okay, give me all the days, all the up days. Okay, write me a function that spits out that splits the entire day into segments of 30 minutes. Okay, so the whole trading day divides equally into segments of 30 minutes. There's 6.5 hours in a trading day, so that means you're gonna have 13 different segments, right? You're gonna have the first 30 minutes, the second 30 minutes, the third 30 minutes, the fourth 30 minutes, etc. So what I'm trying to get here is on a bullish day, where is the likelihood, like what segment of time has the most likelihood to form the low of day? What segment of time has the most likelihood to form the high of day? And we'll talk about why this could be exceedingly useful in minutes. So then, given that data, I want the following statistics. Boom. The chance, round decimal, or only two decimal places, please. This is so we don't get numbers like 0.254654321, and that's going to fill up the whole screen. The chance that each individual segment of price has to create the low on a bullish day, and the chance each individual segment has the high on a bullish day. And then I also need to do this for boom, bearish days. Bearish day on a bearish day. Please, in the output, don't refer to them as segments. Refer to them as the time window itself. So see if this creates the right function. So basically I'm wanting a function that's going to tell me the likelihood of each individual one of the 13 30-minute windows in a particular day to create the high or the low of the day. You can imagine why that could be useful, but you probably don't understand why that could be fully useful, because it could be even more useful than you think. So let it rock. I need to create a function that splits the entire day into 30-minute intervals. Once that's done, the challenge will be to calculate a probability that each window will have the low and the high during the both bullish and the bearish days, only with two decimal places. I need to make sure that I don't refer to these as segments, but it's set time windows. So I have a data set with the candles. I need to split each day into 13 segments of 30 minutes. For each segment, I need to calculate, it'll print out the low and high on both bull and bearish days. For a bullish day, this means checking if a segment holds the day's low or high. Create the low and create the high correctly. Chance, but is that a fraction or a percentage? I'm thinking it's a fraction given the phrasing. For each day, I'll divide the lowest and highest prices with the appropriate segments. For bullish days, I'll track the lows and highs that occur. Similarly, I'll do this for bearish days. Create a low means AI is retarded. Clearly, creating low means the lowest price of the day. For time window representation, I already have the stats, by the way. So, I might be able to back this up a little bit if I go ahead and open this file. Well, do I need to blur this? Yeah, I do need to blur this. So I could open this in Notepad. Bingo. So I already have the data here. So if it gets it wrong, if it gets it wrong, I'll know. But I just want to. I've already done these examples before. I just want to make sure that if it gets it wrong, I'll know. Right. So we want to throw in FD example data, bingo, and then boom, Python MiniPy. Here we go. This is not exactly exactly what I want. So let me ask this. Please make the output visualization nicer. Nicer. Here we go. Because there's more we could do with this too that I think could make it even better. So let me let this run. I asked to make the visualization nicer. Anyways, I'm just going to use the data I already have because this is going to take a while. But so basically what I ended up doing is I said, for every time that it could make the low, what is the chance that the next one's going to make the high? So if the daily low is between 9:30 and 10, so for example here, if the daily low is between 9:30 and 10, these are the percentages of what time window it's going to create the daily high in. So this could be highly useful because I know if the low of the day, I believe, is created within this time window, that means the highest likelihood of where the high of the day is going to be created is in the last time window, so 1530 to 1600. So why is this so useful? Because this could be highly useful, right? So this is that high of the day right there. Well, I could tell you that, for example, we created a high here during this 11 to 11:30 area right here. So if we're coming close to the high of the day, like if I am convinced that this is the low of the day in the first hour, I know that from 11 to 11:30 here, there's only a 4.9% chance that this is the high. So what does that actually mean? That means by the end of the day, there is a 95% chance that this high gets ran by the end of the day, right? If you just do a little bit of understanding. I don't know. I'm not good at math, but that's what I take out of it. And right at the end of the day, that gets ran, right? So if you're coming into the final hour, for example, or the final 30 minutes, or even the full final hour, and we haven't ran that high, you could be like, well, I'm pretty sure that high is going to run because there's a much higher, like there's only a 4.9% chance that this is where the high of the day forms if the low of the day has already formed here, for example. And you can understand why that could be so incredibly useful for understanding price action. So let's go to another day, for example. Just any day. It doesn't really matter, right? All the data should be relatively similar. So let's say that you have the opening price of price right here. Okay. Overall, this was an update. So in this particular day, between the first section here and here, low a day was created. How do we know that? This is where your technical system is going to need to come in, right? And you could also have stats for that. I could give you more ideas for this, right? Like, by what time on bullish days is it most likely that the low day has been put in? Because it might be like by this time, it's like 90% likely that the low of day is for sure put in. So then you could even be more confident that this level is going to be low day. I'm not going to run that simulation for you, but you could start to imagine different things that you could do with this. For example, so we understand if the low day was created there, it's the highest likelihood that the high of day is going to be created in the final hour, which I don't think is what's actually useful about this, because that's common sense. What's really useful about this for me is that when I see a high get formed here between, what's it called? For example, between 11 right here and 11:30, when I see this high get created right here, I understand that between 11 and 11:30, this high only has a 4.9% chance of being high of day. So on this pullback, and I could have statistics where it's like, well, by the 1, 2, 3, 4, by the fifth segment, how likely is it that the low or high of day has already been put in? If the answer is like 60%, then I know that, and by the way, we already know that it's 60%. We actually know that it's 60% because this is the first 30-minute range. And look at what we've already done. From our previous calculations, we already broke above this range, right? We traded higher than this. So it's a very high probability. It's a 60% chance that price does not run the low beneath that 30-minute range now. And this midday high that just got created that we just pulled back down from, there's only a 4.9% chance that this is the actual high of day, right? So there's a universe where on this pullback, you could get very excited about long positions in any long setups that you find in this pullback. You could feel more confident to actually hold to that high because there's at least, if this is only a 4.9% chance to be high of day, and this is a 60% chance to be the low, and let's say you have other technical analysis on here that's giving you reason to be bullish, this has a very high likelihood of at least breaking that high. Okay, well then later in the day, another high forms, right? And where does this high form? This high forms between 13, right? Because that's the up candle, and 12:30. So between 12:30 and 13, it's only 4.29% likely. So this high has only a 4.29% chance of being the high day. So we know that on a pullback, right, we could get pretty bullish into that high. Like, we could potentially treat anything underneath here like as a liquidity sweep. If bullish setups happen, we could get more bullish into that high. Does that make sense? And we have another high that gets created right here, and it's going to be the same thing, right? And you could do this on and on and on, where you could start to find really cool odds enhancers for your trading strategy that's going to make your life way easier. So what is this? This is from 1330 to 1400. 1330 to 1400. This has a 6.2% chance of being high of day. So this is getting a little bit up there. A 5% chance isn't high at all, but this pullback, if it didn't, by the end of the day, if it did not run that high, that would be a rare occurrence. That would only happen 6.2% of the time. In fact, most times it's more likely to make the high in this last hour, which, by the way, is what FMM is trying to play for, right? That FMM setup that I taught, that's what that's trying to play for. So you could start to understand how now you could have statistical data and you could analyze way more things. What's the average amount of up candles? What's the average a trend exist? How long do range-bound markets typically last? What day of week is more likely to create a low or a high? If Friday's low breaks Monday's high, if Monday's a bull bar, Tuesday's a inside bar, what's the likelihood of Thursday not trading below Tuesday's low and also trading above Monday's high, for example? There's so many different combinations of data that you could track. And if you look at data long enough, especially over such a long period of time, you're going to start noticing things that are so highly likely to happen that on the charts, and you have literally 5.7 million bars of data backing up these claims that you're making in your head. If these setups start to occur, and these highly likely things start to occur, you can then actually feel way more confident taking it, because the odds have been boosted so dramatically. So yeah, here's how you do it. This is how I'm doing it, right? You could download bullish days. You could download just daily candles. You could download 5-minute candle data if you want to. This is a really cool way of analyzing data and finding statistical anomalies to improve your trading. Join my Discord if you want to learn how I trade even more so. This is the bleeding edge stuff. I have not implemented anything from this into my trading yet, but I will be for sure. This is the bleeding edge of what I'm doing to try to get better, and hopefully it can help you as well. You might even discover extremely profitable mechanical systems to trade, for example. So yeah, with that being said, hopefully you enjoyed this video. Nobody's still watching because this video was way more technical than normal and probably a little bit more boring, but hey, if you are still watching, hopefully this helps you. I'll see you guys later.